Okay, so today we're talking about how to analyze a private investment deal in venture capital, angel investing, or crowd investing. Getting right into it, we have a couple of questions that we need to know before starting the investment process. Are you investing along other people? If yes, you need to consult with the other investors, and it's better to cross-check your results. Also, you should ask yourself what you can analyze and what you should outsource, because no one knows everything about an investment deal, and that's why it's better to consult with other people in order to make sure that you're not missing anything. For example, if you don't know the domain of a business, it's a good idea to consult with an expert in that domain. That's what big venture capital firms do in order to be able to invest in a lot of different sectors. Now, there's a side note here. If you don't know the domain, it's extremely risky to invest in it, even when you're consulting with an expert. What's better is to know a specific domain and to invest around it, not outside of your area of expertise. Two other people that you should always consult with when it comes to an investment deal are an accountant, which can analyze the financial situations in order to validate them and to make sure that there are no red flags, and also a lawyer, which can help you on the legal side to make sure that the business is structured okay, the deal has no problems, and also that there are no regulations stopping the business from being able to grow. The first thing that you need is access to the data room if it's available. Not every company will have a data room, and especially if you're one of the first investors that they are talking with. The next thing that you need is the pitch deck, which should contain all of the high-level information in order for you to get an idea about the business. Pitch decks can come in all shapes and sizes, but what's important is for them to contain the information that you need in order to make your initial decision. Depending on what's included in the pitch deck, you might also need access to the cap table and also to financial metrics and projections if they weren't included in the initial pitch deck. In order to properly be able to analyze the deal and understand if it's something that you want to invest in, you will have to invest a lot of time and you will need a lot of patience, both from you but also from the founder side. If there's a lack of those, it's a red flag. I've heard a lot of stories and I've also seen this situation firsthand where a founder will try to claim that they need to close the deal within the next month, and if you want to get in, you need to make a decision faster. But this is actually just trying to hide a lot of problems, and you should always avoid those kind of situations. When it comes to analyzing an investment deal, it's always better to miss out on great opportunities than to rush through the process and risk making mistakes. Now, depending on the vertical, there might be other more domain-specific things that you will need in order to analyze the deal. For example, if you're investing in a tech product, you might require access to the code in order to make sure that the product is as good as the founders claim it is. Now, here are some of the things that you should pay attention to when it comes to analyzing those documents that we've just mentioned and going through the due diligence. The first one is the founders. Are they fit to solve the problems? Are they high agency? Can they deliver on what they have promised? And also, are there any red flags? Like, for example, talking bad about the market, clients, or competitors. When it comes to the solution or the product, it's important to know if it's making a significant impact. Meaning, is it only increasing, for example, the productivity by 10%, or is it actually changing the game, making the business that much better? On the same topic, it's also important to know if that product is actually solving a problem. Is there a problem, or is it just an assumption? When it comes to the market of a company, it's important to understand if there are enough clients, if they can afford the product, and also what's the growth potential for that market. Is it a growing one or a shrinking one? What's important to understand here is that if the market is not big enough or if it's not growing fast, you might not be able to justify that investment compared to investing in a different company. So you're not only looking at the potential of one investment, but you're looking at the potential of this investment compared to all of the others that you might have. On the financial side, it's important to understand that not all of the metrics are what they seem to be. In the case of ARR versus churn, is the place where most investors tend to get too overhyped. 1 million ARR is just actually around $83,000 per month. But $83,000 per month doesn't mean $1 million per year, because you also need to consider churn. If it's a subscription and the majority of the customers decide they don't want to renew in the next month, that ARR is completely gone. Founders will try to use numbers in their advantage in order to increase the appeal of their company. But what's important for investors is for them to determine if the company actually has that value or not. You should also take a look at the sales process duration, because a company with a longer sales cycle will be harder to grow, and also it will require more capital in order to survive until they can close a deal. When it comes to burn rate and the runway, companies with a high burn rate have a higher risk of bankruptcy, because if they spend too much money, they will run out of it before they can raise another round, and you don't want that. When it comes to valuations, you should make sure that the multiples used are in line with similar companies from the same domain, or even with competitors if you have access to that data, and you can for sure search it online. You should also avoid overhyped domains, because overhyped domains cause higher valuations without real value. You can see that in the .com, Web3, and also recently with AI. Now, there might be companies in those overhyped domains that actually have real valuations that make sense, but it's harder to find them and they are the outliers. If you're wondering why you should care about valuations, there are two reasons. The first one, it shows how much value you're getting for your money and you want to maximize that. And the second one is that you don't want a valuation that's too high. A valuation that's too high makes it harder to raise in the future, because neither the founders or the investors will want to do a down round unless extremely necessary. But if the market goes down, new investors won't be willing to pay as much for the company. On the competition side, you need to know how is the company different, and also you need to know that a cheaper price is not an advantage. So you should avoid investing in companies that are trying to compete on price. There will always come a competitor that will try to sell something for a cheaper price, but a cheap price is not always sustainable for the long term. You should also take a look at the other investors in the deal. Is there someone that's willing to take the lead on this investment? Are there strategic investors, or they are looking just for money? The location of the investment is also important, but this can vary depending on the stage of the business, so you need to understand the context and make a decision based on that. The cap table is another big reason why investors will not be willing to invest in a certain company. For example, if there are too many investors in a cap table, it will make it hard to make decisions, which is a problem. And also, if the founders are too diluted, then there's no incentive for them to focus on the company and grow it as fast as possible. So take a look at the cap table as well. Now, let's take a look at the step-by-step plan of analyzing an investment deal, and I've created a Figma file for this. Let's move over to that one. Now let's get straight into this. Analyze the pitch deck, the solution, the market, the founders, and so on. Does it fit your thesis? If not, stop. If it does, let's go to the next step. Meet the founders. Can they deliver? Do you believe, based on your interactions, that they are fit to run the company? If you don't think so, stop. If you think they are, let's go to the next step. Analyze the deal. Does it have enough potential? Are you wasting your money on this? If you think that you are, you should stop. If not, we can continue. The financial, legal, tech, and other aspects, due diligence. If there are no red flags, you can invest. But if you find any red flags at all, you should stop. This is just an example of an analysis that you can do for an investment. Most investors will use their gut feeling at any of those steps in order to determine red flags. And if you find any at all, or if your gut is telling you that this is not the opportunity for you, you need to stop. What's important is for you to be able to determine your own process based on what we've discussed so far, and to be able to analyze the deal with all of the aspects that you care about and remove those that you don't care about. Each investor will have its own process, and that's why it's a good idea to share your results among investors and to make sure that you're making the right decision together. Now let me share with you a bonus tip because you've stayed until the end. And that is that IP is useless if it's hard to defend, or if the company doesn't have enough resources. I've seen a lot of companies trying to claim that their valuation is higher because they have patents and no one else can make the same product as they do. But in reality, that's not completely true, because someone else can come and make a slightly different product and the patent no longer applies. If the patent is not generic enough, someone else will always come and make a better product. Even if the patent is broad enough, if someone breaches it, it's extremely hard to fight them, because it requires a lot of resources to fight a legal battle, and most of the time the only winners are the lawyers handling the situation. Thank you for watching until the end. That should be all of the information that you need, at least the high level one, in order to analyze a deal. And if you want me to get more in detail about any of the topics that we've talked about, let me know in the comments below.